Any other?
I'm okay.
All right. So Kyle has given us the go ahead. Let's get started then. All right, I'm going to go at a fairly rapid clip. Not going to overly become overly pedantic about explanations. So I would invite you to stop me if a certain part didn't quite make sense. I can try to explain it in other words, but I'm not necessarily going to dwell on every slide for extended periods of time. Instead, what I would like to do is to spend more time on the activities. During the activities, though, I will give time for people to sort of gather together and work, during which time I will be pausing the recording so that there are not any extended periods of silence. I may put you folks into breakout sessions rather than have people work individually. So please be ready for that. Join the breakout sessions, and because you will have to do group work. So it's a good idea to get acquainted with other people and get a sense of who you might want to work with, right? So getting started, the first chapter sort of sets the tone for what this course is about. It's the introductory chapter in which there's a bunch of learning objectives. The author goes through a description of how accounting evolved and spends a fair bit of time discussing what happened in the infamous market meltdown in the years 2007, 2008. Now that does sound like a long time ago, right? It's almost 15 years now. But some of the after effects of that particular crisis resulted in a prolonged period of low interest rates, which now is coming back to bite us, right? Now that inflation has reared its ugly head and the central bankers are raising interest rates to tame inflation. Well, part of the problem lies in the fact that for a very, very, very long period of time, um, the central banks had to keep interest rates at nearly a rate of zero because the financial markets suffered catastrophic losses in 2007-8. So some of the lessons there should still be timely, should still be apropos, and especially in hot housing markets like Toronto and Vancouver, some of the things that occurred at that time in the U.S. Might unravel here in Canada as well. So it's a cautionary tale that we ought to be aware of. We will look at a general idea about what the rest of the course will entail. Not necessarily going to read every learning objectives. We'll talk about them as we go. So in terms of the evolution of accounting, the origin of accounting can be traced all the way back thousands of years ago to Sumerian times. The Code of Hammurabi. From that time, people used to make inscriptions on clay tablets to keep track of transactions that occurred. But accounting as we know it today, double entry bookkeeping, etc., emanated in the 15th century, late 15th century, when the Venetian monk Luca Paciolo wrote his treatise on double entry bookkeeping. Luca Paciolo was the recipient of largesse from the Medici family. So it is said often that the Medicis were the original contributors, but at the end of the day, the manuscript was written by Luca Paciolo, and that's when double entry bookkeeping became formalized, and it spread pretty rapidly. Prior to that, surely accounting records were maintained, but they were not maintained in the same manner as we are accustomed to today, that we are accustomed to seeing for every debit there being an equal and opposite credit, the duality, the accounting equation that assets must equal liabilities plus whatever's left is equity. Those kinds of notions became mainstream from the 15th century onwards. Accounting became more and more compelling and required with the constitutions of um, limited liability companies. The first ones were expeditionary companies like the Dutch East India Company, followed by the British East India Company. And then in the 19th century, mid 19th century, the English Companies Act was promulgated, which really kind of gave a sense of respectability to limited liability corporations. And so the idea that the corporation as a legal being that would continue to exist even after its original founders, shareholders have passed on, uh, made it in an essence, the need for creation of an artificial period of time for which performance statements needed to be prepared. Prior to that, you would have merchants get together, pool money, buy merchandise that they would sell to foreign lands, hire a ship, sail the ship. The ship comes back in a couple of years' time. You sell off whatever goodies were brought from abroad and divvy up the profit. So you did not really need the sense of this artificial period of time which now we are so accustomed to that we are able to prepare an income statement for a year ended such and such. So the fact that we can conceive of a financial year that begins, that starts at a certain point, ends 12 months later, all of this was alien prior to this notion that you can have a joint stock company that would possibly exist for hundreds of years after incorporation. Businesses used to have a smaller shelf life prior to that. And yes, over time, taxation came up and it was supposed to be a limited measure, and it never went away. And so that added another um, requirement for accounting because for corporations, taxes would be assessed on income, and the computation of income was something that accounting helped in in facilitating. Then moving on to the 20th century, there was the stock market crash leading to the Great Depression. The Great Depression, uh, one of the underlying, well, not the reasons per se, but one of the symptoms that were seen was that the small investor was not protected at the time because companies were overstating their assets in the second decade, sorry, the third decade in the 1920s, and so because they were providing inflated values for the assets, there was in the lead up to the Great Depression, there was a big run up to the stock markets, and then we saw the crash, right? And that crash lasted for a prolonged period of time. There are horror stories about people jumping out of hotel windows, committing suicide and that kind of thing. And the SEC, the Securities and Exchange Commission, was instituted in 1934 in response to the outcry and the need to protect the little man. I'm gonna sound sexist, but at that time there were predominantly men that were involved in finance and such calumny, and so the the accounting response was if companies are, if part of the underlying reason for the stock market crash was that companies were overstating their assets helter-skelter. To rein in such willful overstatement of asset values, the notion of conservatism, prudence was constituted, and the need to prepare financial statements in accordance with historical cost became paramount. And notice that as time goes by, we have moved away from historical costs. We are moving again back to this notion that accounting numbers have to represent fair values. and fair values are approximations of what the assets are worth today. And in most cases, asset values tend to go up, right? So there will be these cycles. There will be these cycles where people would say accounting records are useless unless they provide information about how much the company's worth today. And when we look at the possibility that such measurements are fraught with errors, we will again, like the age old question of what is the right way of accounting, uh, doesn't seem to be answered for once and for all. Like we continue with these phases of how accounting needs to be keep getting better to serve the needs of its users. So the Securities and Exchange Commission, as I mentioned, was established in 1934, and the Securities and Exchange Commission is the body in the United States of America that takes care of financial reporting requirements for publicly listed companies in the United States. In Canada, we have provincial securities commissions. The big daddy is the Ontario Securities Commission because that's where we have the Toronto Stock Exchange, and the OSC takes care of the reporting requirements for companies that are listed on the Toronto Stock Exchange. In the US, it's the Securities and Exchange Commission, SEC. The SEC is important for us in Canada because, look, I mean, Canada is a small fraction the size of the US in terms of just the size of its financial markets. A lot of Canadian companies raise capital in the United States, and very often the legislations that are passed by the SEC in Canada, we adopt very similar versions of such legislation as well. So what happened in the US was the SEC was responsible for promulgating all the legislation concerning reporting by publicly listed companies. Now they chose to not keep the job of defining the financial reporting standards. That they passed on to the American Institute of Certified Public Accountants, the AICPA. And there have been phases of development. 1973 is when the Financial Accounting Standards Board, FASB or FASB as we would call them, uh, were founded. Prior to that, we had the Accounting Principles Board, and before that, there was a Committee on Accounting Procedure. In Canada, we had in 1946, so right after the Second World War ended, there was the Committee on Accounting and Auditing Research that was founded, which has over time morphed into the current Accounting Standards Board of Canada. It was the CICA, now CPA Canada. It's a body of chartered accountants were basically the ones that established reporting standards in Canada. And as we know, the profession has now merged. We used to have three different accounting designations. We had the CAs, chartered accountants, the certified management accountants, CMAs, and the certified general accountants, CGAs. They merged about a decade ago into the chartered professional accountant designation that we have currently. And the Accounting Standards Board is the body that decides what the reporting standards should be in Canada. Now, just a quick poll, do we know what reporting standards apply to publicly accountable companies in Canada?
IFRS.
IFRS, International Financial Reporting Standard, absolutely. So they are part one of the CPA handbook. The CPA handbook comprises of 4 parts in total. First part is IFRS. So in Canada, for a long time, we were actually trying to adopt US GAAP. We were trying to harmonize with United States GAAP. The FASB started talks with the International Accounting Standards Committee, IASC, which over time became the International Accounting Standards Board. And there was speculation that the United States would, over time, either end up adopting IFRS or would converge their accounting standards, reporting standards to the IFRS, International Financial Reporting Standards. By the way, there is history for that as well. Before they started being called International Financial Reporting Standards, they used to be International Accounting Standards, IASs. So you will still see a bunch of standards still named IAS. For example, the standard on inventories is IAS 2, right? There are a bunch of other IASs that are still in play, but uh, the nomenclature has since moved from international accounting standards to international financial reporting standards. Anyhow, after many years of working together and still not making any headway, the FASB folks and the IASB folks decided it was time to call it quits. The IFRS 16, I believe, was the last standard that they actually worked on together. IFRS 16 is the standard on leases. And after that, they've decided to go their own ways. The folks in the US feel that their needs are very specific and they cannot be addressed by the principles-based IFRSs. They need to provide more guidance for application, etc. And anyhow, long story short, while Canada was waiting to see the outcome, the good folks in Canada, the Accounting Standards Board decided, you know what, probably we'll be better off going with international standards rather than the US standard. Uh, and we made the commitment. And since the year 2011, we've been requiring publicly accountable companies to report under IFRS. We do have part two of the accounting handbook. Does anybody remember what that's called? Part one is IFRS. There are four parts to the CPA handbook. Part one's IFRS applies to public companies. Part two applies to private companies. That's the hint.
ASPE,
ASPE, accounting standards for
private enterprises.
private enterprises. Yes, very good. So now that standard, if a company is a private company, they can they can choose IFRS if they want, right? So sometimes people think, oh, if it's a private company, then it has to follow ASPE. Not really. A private company can very well follow IFRS if they want to, but most private companies choose not to go with IFRS because of the reporting costs. IFRS requires a lot of disclosure, and private companies just don't want the additional headache that comes with such reporting requirements. And so ASPE is, in a way, I would say, simpler for private companies to apply. And ASPE also tends to be, although ASPE also tends to be or claim that it's more principles based, ASPE has retained some of the specific guidance that US GAAP used to have. So ASPE is what's left of the old Canadian GAAP, right? The old Canadian GAAP that was applicable up to December 31st, 2010. And the old Canadian GAAP was very similar to US GAAP, right? So the accounting standards that apply in the United States, in Canada, our accounting standards used to be very similar. One example that you might recall from your recent accounting course, I'm assuming most of you have taken intermediate 2, is the lease classification criteria for ASPE. So when we talk about the length of the lease term covers 75% of the economic useful life of the asset, or the present value of lease payments is 90% or more of the fair value of the asset. Well, those bright line rules, those specific pieces of guidance, were part of US GAAP. IFRS doesn't have any of those guidances, and yet we've retained those bright line rules. Okay, so ASPE in a way is, one would argue, doesn't have too much of fluff, too much of gray area. It has these bright line rules. So, okay, if the length of the lease is not 75% of the economic life, you don't have to record it as a capital lease, that kind of. So private companies like those rules, because once the rules are clearly articulated, then a company that wants to bypass those rules or work around the rules can figure out ways of doing it, right? IFRS doesn't leave room, like you folks will remember again from the leasing standard, IFRS 16, that a lease, unless it's a low value lease or a short duration lease, you have to record a right of use asset and a lease liability. So IFRS doesn't really allow companies to record an operating lease. Like the lessee has to report the lease liability on its books, which is something that US GAAP still allows companies not to report the liability. Right? So there have been over time uh, arisen significant differences in how IFRS operates and how US GAAP operates. We have a little bit of that in the form of ASPE in Canada. Just to wrap up that discussion, the part 3 of the Canadian handbook, CPA Canada handbook, is accounting standards for not-for-profit organizations, which are at SAIT covered as part of the advanced accounting class. And part 4 is a very specific set of standards applicable for pension plans. Anyhow, so that's the wrap up. There used to be part 5, which was the old Canadian GAAP. That's no more there. In the US, the Statement of Basic Accounting Theory, ASOBAT, was issued by the American Accounting Association in 1966. And that was the germ of the conceptual framework. So what's accounting? Who does it exist for? You probably recall the definition of accounting, right? The purpose, the role of financial reporting is to provide information that is useful to investors and creditors, right? That's the definition that you probably recall from an introductory accounting course. And that definition comes from the conceptual framework, right? Useful accounting information is one that IFRS says is relevant and is a faithful representation. And US GAAP takes a different view, which is captured in ASPE as well. You probably recall useful information needs to be relevant, reliable, timely. Timeliness is part of relevance, right? Understandable. I'm confused. But it's there in the conceptual framework. So the very first germ of the conceptual framework arose in 1966, and there have been additions, refinements of these concepts. 1970s was the time when inflation was really drastic. 1970s, we hope that we do not get to see inflation levels of the type that we saw in the 1970s. That was the time when the central banks raised interest rates to, into the 20s. You had interest rates of 21, 22% on mortgages. So, if we feel that current mortgage rates are high, man, that time was really tough. And at that time, the accounting folks responded with the development of something called inflation accounting. So price level adjusted financial statements. You didn't really have 1 year's numbers being comparable to the next year, just given that the rate of inflation was so high. 1980s is when the central banks in North America were able to tame inflation down to a level that they were comfortable with. And since then, there has been a commitment to keep inflation low. And by low, although not always specifically defined, the range has been between 1 and 3%. You don't want inflation to be too high. And that was supportive of our continued use of historical cost accounting, right? So the fact that we were able to prepare a balance sheet based on historical cost numbers, the monetary unit assumption that we would have read about in our intro accounting courses, that talks about the assumption that the unit in which the unit of accounting is the dollar, and we assume that our dollar is stable. Now, as of now, when we see inflation rates are 6, 7, 8%, as high as 10, 11% in the UK, that assumption is kind of becoming tenuous now, right? And so if inflation were to persist for a protracted period of time, I wonder if we would be able to compare the financial statements from, say, 2019 to the financial statements from 2023 and say, oh, yeah, they're largely comparable, because inflation would have eroded a lot of the value of the assets that are presented on the balance sheet, right? So this is something to be aware of as you folks work on. So are we able to compare those numbers on a dollar for dollar basis? As long as the rate of inflation was nominal, was small, we could, right? We could just assume, all right, with a couple percent inflation, last year's numbers, I can more or less compare to this year. When inflation rates go out of hand, those assumptions start falling. Then in the late 1990s, there was the dot-com bubble that got inflated again because of low interest rates. That was the time when companies, due to the need for outsourcing, so they wanted to outsource a lot of the support functions to far-flung places like India, the Philippines, etc. They needed um, telecommunications uh, to be widely distributed. So they laid the fiber optic cables on the ocean beds connecting uh, the continents, North America to Asia, Africa, etc. And that there was huge hope that the internet companies would be the next superstars. Then in the early 2000s, there was that bubble burst. To be Now, to be fair, we do have these large behemoths now, Amazon and Google, etc. They are great, they are grand, but we see these phases in which sometimes people would, just bid up the prices like crazy. Oh yeah, there's no tomorrow. That's the lockdowns came, and the valuation of the company that provides our service here, Zoom, they went crazy. And then when the lockdowns were lifted, and interest rates started going up, a lot of these tech companies, because they're financed with debt capital, and they don't have large amounts of earnings, their stock prices started tumbling down and down. Shopify is the example as well. So these phases happen, right? Investors get very excited about a certain idea, and everybody wants to jump on the bandwagon. Um, but there has been the fact that if you look carefully at the accounting numbers of the companies, very often stock prices tend to get too far ahead of the accounting. And when people realize, it's almost like that Wile E. Coyote moment, right? If you remember from the Roadrunner series, you had that coyote jump over the cliff, and for a while would seem like running in thin air and then drop. You see these phases happen from time and time again, right? The dot-com boom and bust. We saw debacles, accounting standards, debacles for companies like Enron, WorldCom, uh, that resulted in a large accounting firm like Arthur Andersen to just wind up. Uh, require, and people started asking, what are the regulators doing? 2002 is when strict regulations about uh, liability, responsibility for reporting being placed on top management of companies came in the form of the Sarbanes-Oxley Act in the US. And in Canada, we had our own version implemented. So there have been lots and lots of changes over the years. 2024, we expect 130 jurisdictions will be using IFRSs. I think we've already hit that number. These numbers are, these dates are incorrect. Hang on. This should be 2011, and 2014 is when we hit 130. So my apologies, that's a typo there. IFRS has been going from strength to strength. Okay, is there anything else that I need to talk about here? Not really. Okay, 2007, 2008, I briefly mentioned what happened there. Is everybody familiar with the story of the 2007, 2008 financial crisis, liquidity crisis? Maybe, maybe not.
Did it
Okay.
have something to do with like mortgages and
Yeah,
stuff like that?
yeah. So,
I don't know like the full details.
all right.
That's my understanding of it.
Okay, sounds good. I'm gonna assign an activity. Give me a second. Let me just bring this recording to a pause. Bring the recording. So based on the video that you watched, part of the reason why we had the financial crisis, the credit crisis that we saw in 2007, 2008, and it unfolded in the form of a lot of loss of value in the housing sector, was basically excessive risk taking on the part of the mortgage originators, because they felt that they could make money through fees that they would levy, and they could, they didn't have to keep the risk of the mortgages on their books. They could just sell the mortgages in the form of asset-backed paper, collateralized debt obligations, and so on to the other buyers. And that went kept going on and on and on until the proverbial shit hit the fan, and then it was the time for reckoning. There was also inadequate regulation at that time, which caused allowed for such practices to continue. Now, something along the lines, one could argue, is happening in Canada as well right now in the super hot housing markets, or until recently, the super hot housing markets in Toronto and Vancouver, where a lot of mortgages are being originated. Um, um, I don't have proof, but anecdotal stories indicate that a lot of these mortgages are being processed based on shady paperwork. Home Capital Group came under fire a few years ago because they had mortgage brokers working for them that were getting mortgages issued in the names of potential home buyers using forged documents, right? So you have to show a certain amount of income and so on. And there were parties that didn't have sufficient income levels, and the paperwork was being forged. Something similar was happening in the United States. You had people, essentially full-time students with no job, right? So no income, no job, no assets. They call them ninja loans, NINGA. No income, no job, no assets. Yeah, go ahead, buy a house, buy an $800,000 US house, because of course house prices keep going up. until they don't. And when they didn't, then you had places like Arizona, California, a whole bunch of other places which where literally housing prices plummeted and people's equities got wiped out. And stateside, people can walk away from mortgage debt. And that's precisely what happened. People just, filed for bankruptcy and walked away from mortgages that were underwater. In Canada, it's going to be a tricky one because we can't really walk away from mortgage debt, but some of the valuations were going on a really, really, really crazy pace. So let's hope, fingers crossed, things don't go that bad in Canada, but you have the makings of a similar bubble here as well. Why should we care? Well, as taxpayers of Canada, we should care because if such a thing happens, the result would likely be a really severe recession, and that is going to impact the government's ability to provide for the services that we have come to expect. So this is going to be a problem for all of us to face up to, and certainly as accountants in the making, when recessions hit, um, the job market rise up as well, and hopefully that does not affect us negatively. So something to be aware of for sure. As far as the implications for accounting go, you can't allow businesses to operate um, in a setting where the deals are not clear. The deals are sort of occur in a gray domain. So we need more transparency for sure. And you have to understand that when people talk about, oh, accounting is useless, especially folks in finance make allegations against accounting saying accounting numbers are useless because all they tell us about is the past, whereas we need information about the future. So we need to know what the company is worth today. So we need more fair values. And we in accounting have been responding to such demands. We've been embarrassed and we said, oh yeah, we got to do more, we got to do more. And you got to keep in mind that fair values are great as long as they represent a price that a knowledgeable and willing party would be, would want to exchange an asset for in the normal course of business. But there can be circumstances when the normal rules don't apply. And at that time, the market prices could represent distress pricing, and they are not fair values. And that is what we saw in the 0708 crisis. Fair value accounting. When we talk about fair values, we're said, oh, there are three levels of fair values. One, directly observable prices if you have publicly listed assets, and that's great for stocks. Secondly, values that you can infer from looking at similar assets that have been recently exchanged. And then thirdly, values that you come up with in the notion of value in use, which are basically discounted cash flow numbers, net present value type numbers. The level 2, level 3 fair values, if you are planning on using them, unless you're operating in stable, normal, quote unquote, normal circumstances, they are not necessarily reflective of actual fair values. And um, to report asset values at such amounts may not necessarily result in actual usable information. It can actually do more damage than good. And that is something that banks did in the 0708 crisis. The banks in the US, they were big proponents of mark-to-market accounting rules. So for the length of time that asset values, the mortgage values kept going up and up and up, the banks loved it, right? Oh yeah, we're going to mark to market. We're going to report our assets at fair value, fair value. And then when the asset value started tanking, the banks in the US were the ones to lobby against the use of mark to market accounting. We don't want to report the fair values, right? The fair values were essentially market price. But because the markets en masse were tanking, the bank said, no, 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 we don't want to report these fair values because they are not representative of true value. And so at that point in time, there was a moratorium put on reporting fair values where the banks were allowed to get off of the mark-to-market requirements. And that was one of the reasons why IFRS 9 came into being, right? The new financial reporting, the financial instrument standard that we have in IFRS 9 was a response to that. Companies were able to cherry pick. They used to be able to classify their securities, their assets as available for sale. Any changes in value they would report in other comprehensive income, and then they would decide when to realize the gain and bring the gain back into net income, right? So they were able to do a bit of financial shenanigans, and IFRS 9 basically has put paid to that, right? So if you have shares, you can use OCI, but it's a one-time election and you can't change your mind. And if you use OCI as the basis for investments in bonds, any gain or loss has to be brought back into net income. So for those of you that remember uh, accounting for financial instruments, you will recall that the ability for companies to cherry pick their accounting gains and losses has been vastly minimized now by IFRS. And IFRS 9 has been a response to the 0708 crisis. Um, Off-balance sheet activities, well, IFRS 16 is a classic example. Companies were able to keep a lot of their leases off balance sheet because they were able to work with the lessors to be able to classify the leases as operating leases instead of capital leases. And that just resulted in a lot of the risk not being apparent to financial statement users. Well, now that's just not possible. Companies have to capitalize leases, report the lease liability and the right of use asset. The requirements for consolidation were shaky in the past, and that allowed companies like Enron to have a whole host of um, variable interest entities that they kept off of balance sheet. Now, for those of you that have taken advanced financial accounting, you would recall that that's just not possible. Any variable interest entity has to be consolidated by the primary beneficiary. So this need for consolidation, again, was in direct response to such shortcomings in the then existing financial reporting standards. And of course, the crisis teaches us that changes need to be made. And these changes have occurred and they are still being made. Um, the textbook, or at least my slides, did not talk about the more recent evolutions with regards to the greater adoption of big data in accounting. Artificial intelligence is being used on a pretty large scale, especially in auditing. The use of um, blockchain technology. So not necessarily Bitcoin, because Bitcoin, I'm not a huge proponent of it, but the technology that underlies Bitcoin, the blockchain, that holds a lot of promise for accounting, and especially in terms of contract that cannot be tampered with easily. The fact that you have this proof of work being required across the board. So any changes made to the hashes have to be agreed to on a consensus basis and so on. They do have a lot of implication for us in accounting, but it is still, I would say, at this point in time, at a nascent stage. The large public accounting firms have adopted big data, artificial intelligence, and what they so if you've taken a course in audit, you may have read about how audits are supposed to be done according to sample. And there is an audit sample. There's a sampling approach. The big firms nowadays do not do audits based on samples. They audit the entire set of statements, but they're able to do that using artificial intelligence. So that allows for billions of transactions to be sifted through and only highlight the ones that need closer scrutiny. So the whole approach to the world of audit is changing. Banks are using big data to figure out patterns that were not possible to detect in the past, but now with greater improvements to computing power and the availability of such huge volumes of data that are impossible to sift through on a human basis, there's a lot of opportunity that exists out there, and accountants are pretty much in the midst of it, right? So that's something that I did not allude to, um, that's happening out there. So change is a constant, right? In the world of accounting, change is a constant. And, you folks, I'm sure, will be eager to adopt and embrace such change as you face it. If not, well, maybe you will consider teaching, right? Because teaching changes at a much slower pace than real life out there. Then the chapter, after talking about the impact of the 07-08 crisis, goes on to more technical sort of discussion, or not necessarily technical, I would say, but more of a conceptual discussion around efficient contracting, how financial reporting can be seen in terms of just a way of making sure that contracts are seamless, and there's not a whole lot of friction in the way of wastage, because friction results in waste. So contracts can be made more efficient through a judicious use of financial reporting. And so traditionally, proponents of financial reporting, have talked about providing information that is useful for decision making. So, that's what we've been taught, that accounting exists because its purpose is to provide information that is useful for investment decisions for investors and lending decisions for creditors. And that has required financial statements to be both relevant and representationally faithful to economic reality. However, the fact is that, due to the ubiquity of information, due to the fact that, there's a lot of information that becomes available very, very quickly, and it becomes disseminated very, very quickly, such information is not necessarily the basis on which you can earn, or investors can generate supernormal returns. There's not a possibility. So as far as markets go, the need for financial accounting information is likely very, very low, right? You cannot get an advantage. No single person can claim to get an advantage because they have studied accounting information, right? So that's kind of passe now. So instead, one could argue that accounting exists because companies enter into contracts, which are often based on the outcome in accounting terms. So it is to facilitate such contracts that accounting exists, right? So the demand for financial reporting exists because of the contracts that companies enter into. So such contracts could include contracts for borrowing. So if a company, let's say, took out a loan from a bank and the bank stipulated, oh, you need to maintain a debt to equity ratio of no more than 1.5. Well, because that contract now has a stipulation that says the debt to equity ratio shall not exceed 1.5, the enforcement of that contract requires preparation of financial statements by the company, which the bank will not accept unless those numbers are audited, right? So the need that you have audits and so on can be justified from the point of view of that particular contract of borrowing money. You have the example of managerial compensation. So managers, top managers at companies could be paid out bonuses based on certain earnings numbers. And so the fact that they are eligible or ineligible for such bonuses can only be established once financial statements have been prepared, and there should not have been any kind of undue influence on the preparation of those numbers. So again, enter the auditors and so on. So, even though investors and creditors might not care anymore for the accounting numbers are still useful for the efficient execution of such contracts. And of course, accounting helps assist corporate governance. The board of directors, which consists of representatives of owners, um, that provide strategic guidance to the company, they rely on financial numbers because they are not always privy to the day-to-day operations. So they exercise their oversight powers by responding or referring to the financial information. So accounting exists to serve these needs, not necessarily the informational or decisional needs for investors and creditors. We will talk about the comparison of the decision usefulness approach and the efficient contracting approach later. For now, the decision usefulness approach tends to favor fair value accounting, and that's primarily the relevance aspect, whereas the efficient contracting approach tends to favor reliability of numbers. And conservatism is something to be celebrated for the efficient contracting approach, whereas for decision usefulness, conservatism is only a means of avoiding lawsuits, right? So there are different worldviews as to what is important or what the essence of accounting should be. And we will be expanding on these thoughts in future topics. You heard about rules-based and principles-based standards. So the United States GAAP and to some extent ASPE could be argued to be more rules-based. IFRS is primarily principles-based in the sense that we have very little implementation guidance provided in IFRS. So the general principles are enunciated and then the actual implementation is left to the judgment of the users. Whereas in the US GAAP arena, because the United States is possibly a more litigious society, people take others to court really very quickly. You need to have these well-defined boundaries for which these reporting standards are applicable. So there's more of a compliance mentality when it comes to US GAAP. On the flip side, of course, under IFRS, it is possible because there's so much room for professional judgment. People who have other motives could resort to manipulation of numbers. And that's not to say that we have not seen accounting scandals emerge in US. Enron is a US example. Nortel, on the other hand, is a Canadian example. And yes, the numbers for Nortel were prepared under old Canadian GAAP, but admittedly, old Canadian GAAP was still a lot more principles based than the US GAAP would have been. So there's no panacea, there's no sure shot guarantee that if you use one set of standards over the other, you will get more what's the word? More trustworthy numbers. If someone is out to cheat, they will find out a way to cheat for sure. We're going to look at information asymmetry. That's going to be a big theme for us. And it's essentially the fact that information is not equally distributed across the board. And so not having the same quality or quantity of information, or even information at the same time, point in time, can create doubt, lack of trust, and all the wonderful inefficiencies that emanate from it. And you can often argue that accounting exists to overcome such uh, absence of trust between contracting parties. So looking at information asymmetry, some parties of business transactions may have an advantage over others when it comes to access to information. They may know more about something, a particular contracting detail than the other party. So that is called an adverse selection problem. When one party has access to more or better or more timely information than the other party, that creates an adverse selection problem, right? So the other party, right, the party that does not have the same type or information at the same time might feel, oh, am I making the wrong decision? Am I making the wrong call? So there is this doubt that arises in their minds, this lack of trust, which can sometimes result in bad outcomes, bad choices, poor choices. Now that's one side of information asymmetry. You'd also see that information asymmetry results in uh, moral hazard. So the party that has the informational advantage, they might be able to get for themselves a really cool deal, and then after the fact, they can cover up their steps, their bad steps, if you will, cover up their shirking, and because certainly the other party would not know better. Right? So that's moral hazard. And the origins of information asymmetry lie in the world of insurance, where adverse selection is often seen in the form of that a person, um, if you think about life insurance or health insurance, when a person is young and fit, they often do not, they cannot even imagine ever getting older or falling sick, or the likelihood that they might pass away, and their families, not being properly taken care of. So the younger folks, the fitter folks, they typically are not the ones that want to sign up for insurance. Now, the fact that insurance works on the principle of pooling of risk across many, many, many individuals means that, you know, unless healthy people are also willing to take out insurance, the either it may not just not be feasible for the insurance companies to operate, or they might have to ask for really very high rates of premium from the older, less healthy people that are seeking insurance, right? It's usually someone who's older, not as healthy, maybe with pre-existing illnesses and so on, that actively is looking to buy insurance. That's your adverse selection problem. In the world of insurance, people who have a good reason to worry about a possible loss will be the ones who will actively look for insurance. Others will not. That's your adverse selection. Moral hazard is the other part. Once you've gotten insurance, then you stop taking the precautions that normal people should, right? So that's when you undertake activities that are ill-advised. And that's your moral hazard. In the case of companies, you can think about companies that raise money, right? So when a company is going public, going for an initial public offering, they might if the management of the company knows about possible uh, reasons why the company might run into trouble in the future, or there are some inconvenient details that if they do not share with the rest of the market will likely result in the market valuations ending up being too high. You raise a ton of money. That's your adverse selection problem. As a potential investor, I don't know if I have access to all the information. So adverse selection can cause a breakdown in capital markets, right? So if investors are not sure that they know everything that they need to know about the potential investment target, they might just consider the risk as being too high. And often people respond to risk either by requiring an increase in the rate of return, or they might just walk away. Right? They might just say, "Look, I'm just going to walk away. I don't think I can stomach the risk." In either way, from the investee, the company's point of view, either the company has to pay a very high rate of return for the capital, or it might not get access to the capital at all. Yeah. So that's not a good outcome for the company as well. Now, moral hazard is when, let's say, a company raises money and then the management of the company then thinks, oh, this money is not ours. This money is the investors, right? It's so let's go and invest this money in very risky projects. If the project pays off, we'll make a ton of profits and we'll get paid huge bonuses. And let's say if the project doesn't pay off, oh, well, it's not our money anyways, right? So we don't get the profit, we don't get our bonuses, big deal, right? The losses will all be suffered by the investors. That's your moral hazard problem. Both of them are problematic when it comes to financial markets. So in later topics, we will see how information asymmetry, both in the form of adverse selection and moral hazard, impacts the efficient working of capital markets, and how accounting in the form of financial reporting as well as auditing can help us overcome some of these bad impacts of the trust deficit. All right, what's the fundamental problem of accounting theory? We've talked about the two roles of accounting information. One is to provide information to investors, and the second is to help the users assess how well or how poorly management has been making use of the resources that have been entrusted to them. How do we design and implement standards that will combine these two roles? So the role of providing information to investors and allowing for managerial performance to be evaluated. And that is a decades-long question. That's basically what theorists have been trying to answer by coming up with newer proposals of how accounting information can be made more useful, right? So this whole debate about relevance and so on, yes, we talk about it in abstract terms, but there has been work done to fine-tune the accounting information, in terms of exactly what you should report and so on and so forth, which we will evaluate and assess in more detail in future topics. And this is just an expansion of what I talked about, that adverse selection is the investor informing role. Because managers are privy to information about the company on a more real-time basis, they will always know more about the company. They will always have better information, more timely information about what's going on at the company than the owners, the actual owners, ever will. And that creates the trust deficit. And the performance evaluation part is the moral hazard problem. Once managers have been appointed to the position, how do we know whether they are indeed working hard or hardly working? Are their actions indeed taken to enhance the well-being, the welfare of shareholders, or is it to enhance their own personal gains and wealth? Because managers can very well shirk, not work hard, and shareholders would have no way of saying for sure, right? They can always blame bad outcomes on other things, right? Because managers also are the ones that are ultimately responsible for providing the information. So they may end up hiding negative information from shareholders, and shareholders would be none the wiser. So in the midst of all of this, what must accountants do? So certainly provide more timely and credible information. So timeliness back in the day used to be an element of relevance. Now it's an enhancing qualitative characteristic in the IFRS conceptual framework. In US GAAP, timeliness is still part of relevance. Like, you need information to be available when it matters. If that time frame is passed, then it will have less importance. And it's also got to be trustworthy. And that trustworthiness arises from audits, right? So auditing, the whole principle of auditing is based on bridging the trust gap that exists necessarily between the providers of economic resources and the companies, the managers that will actually be putting those resources to use. Okay, the other part is provide numbers that can actually be used to assess managerial performance. So, come up with a number, a net income number that actually tells a story about whether managers, the actions undertaken by managers actually did result in better performance or not, right? And we will be exploring this notion in later chapters, in chapter 9 and so on. We'll expand on these bits about motivating manager performance and managerial labor markets in more details later. So I'm not going to express any details just yet. And finally, when we'll be wrapping up this course with a discussion about regulation. So that would be your last topics. So does having more laws and regulations help or address the fundamental accounting problem? There can, in general terms, exist two possible extreme outcomes or responses. One would be laissez-faire. Let's not do anything. Let the markets sort things out on their own. That has been tried, and usually, for people that feel shackled because there are regulations that inhibit what they feel are their creative abilities to come up with new solutions to problems that maybe didn't exist in the past. There are people who have an inherent dislike for regulation. When things go sideways, though, that's when there are cries for, okay, what were the people in charge doing? And that's when you have the pendulum that swings the other way. You have excessive regulation. Maybe we need a mixed model. Maybe one works better than the other. We will explore these themes in the last topics when we deal with regulations. Does regulation work? You can have all the rules you want, but they might not end up achieving their intended outcome. The reason is you just cannot have a system that is ultimately foolproof. You've probably heard of that saying, where there's a will, there is a way. Where there's a way, there's a lawyer, and so on and so forth. So if people are looking to sidestep regulations, they will figure out a way to do so, right? So regulations can only work towards instilling a sense of expectations, right? So when you know that you should not be doing X, Y, Z, and you should be doing A, B, C, that lays out norms of actions, right? So for people who do not abide by those norms, they know that what they're doing is not right, okay? People will still break the law, right? So the fact that you have a speed limit on a highway doesn't mean that people will not drive faster than the posted speed limit. But whoever is doing so knows at the back of their mind that, there might be a police car that might issue a ticket, or there could be a bad outcome. You know inherently that what you're doing is wrong. So at most, regulation can only achieve that. It does come down to the willingness of parties to actually abide and comply with regulation. And if people don't behave ethically, then no amount of regulation can prevent, right? So that's what I was alluding to. Does regulation work? Well, we will see that it's hard to say. It's hard to say. We are seeing more and more regulation. Um, and we've also been seeing a lot of deregulation in other sectors. Regulation ultimately comes at a cost. Regulation acts as friction. So it does come at a cost. And you got to often ask, are we getting benefits that actually will outweigh the costs? Because if the cost of regulation exceeds the benefits, quite often people will start ignoring or disobeying the existing regulation. People will start finding out ways to break the law. Last little bit, I know it's kind of getting a bit depressing and boring for some of us. So we will be looking at examples of accounting research and how accounting research informs accounting theory, and then ultimately that impacts accounting practice, right? So a lot of the accounting that we have learned in the other courses in intermediate accounting, advanced accounting, and so on, you know, they are an application of accounting standards. Now, a lot of these standards are created by putting um, propositions developed by accounting theorists who will often come up with a theoretical framework, which then accounting researchers go out and see whether that framework actually is valid or not, right? So there is a very close interplay between accounting theory, the actual practice of accounting, and then accounting researchers are able to come up with evidence of whether a particular set of accounting standards is achieving its intended outcome or not, right? So there is a close interplay. And in this course, we will be seeing examples of accounting research, right? I will not inundate you with a lot of those examples, but I will be exposing you to examples of accounting research as well. So accounting research basically helps improve our understanding overall as to whether accounting standards are achieving the outcome or not, right? We will be referring, as I mentioned, to accounting research papers. And at this point in time, I'm going to pause and invite either questions or comments from the floor, or if there are no questions or comments at this point in time, I'll propose a bit of a break for us, a working break, because we are now ready to move on to the next chapter.